Hello, fellow investors, and welcome to another episode of Ritter On Real Estate, where we teach you how to passively invest like a pro. Today, we've got a very special guest. His name is Kenny Wolfe. Kenny is an experienced multifamily syndicator, and he's the founder and CEO of Wolfe Investments. He's also the published author of Investing in the Dream: How to Acquire Multifamily Real Estate and Attain Total Financial Freedom. I can already tell we're going to get along. So Kenny he invested in his first multifamily property in 2010, saw the potential to transform his life. Again, similar story. And it gave him the opportunity to quit his day job, start his own business. And he's passionate about helping others attain financial freedom through real estate investing. He's been involved in over $355 million worth of commercial real estate transactions nationwide. He's a principal in over 5,000 units currently, over 7,000 all time. And he currently resides in Plano, Texas with his wife, daughter, and son. This is kind of interesting. When he's not scouring for deals, he enjoys discovering new vegan restaurants and rooting for the Broncos. So
That's right.
I'm a Colts fan, so I guess we got the Peyton Manning connection. We can,
Awesome. We'll talk about that later.
we can talk about that. I love to talk about that. Talk about Peyton all
Yeah.
day. But anyway,
Yeah.
Kenny, thanks for coming on the show and
Absolutely.
sharing some wisdom with us today.
Yeah. Appreciate it. Thanks, Ken. Appreciate it having me on.
Yeah. So as we always start, let's start with let the group know a little bit more about who you are and how you got to be where you are today.
Sure. So those stats are a little old. No, I don't know. I gotta talk to my
Update the stat card.
assistant about that. Exactly. So we're at 675 million of assets under management today. And by the end of the year, we should be at about $1 billion of assets under management. We again started an existing multifamily. We still buy A class to D class today. The D class we're taking to a B or an A. I think I'm the only one who admits we buy D class in our space, but there's not many that do. But we're taking it to a B and A if we're going to go that far down in quality of asset. And then 6-7 years ago, added 2 arms to the company. So we also have 54 triple net stores. So Dollar Generals, Walgreens, Advanced Auto Parts, properties like that, all our credit tenants. We did that for the cash flow for our investors that wanted just stable monthly cash flow. And then the opposite of stable monthly cash flow is development. So we do ground up multifamily. We have projects in Texas and Ohio right now. And then 3 years ago, fell into buying downtown office buildings and converting them to A-class multifamily. So we have 10 of those projects now, 2.2 million square feet that we're converting today. And those are all for, big appreciation. So it kind of covers the different returns that our investors were looking for in commercial real estate.
Sure. Yeah, it makes complete sense. I love how you guys have created these different strategies, right? Kind of covering the risk continuum and return continuum of real estate investing, right? From the triple net all the way to the probably the ground up, probably on this side. But with your over a decade of real estate experience, I mean, talk about why that's important to have those different strategies, not just rely on one thing, and how that diversification has helped you or your investors. I mean, how do you view that?
Sure. Yeah. So we were doing existing multifamily. And then we had a few of our investors that wanted more of a monthly stable cash flow deal. And so I reached out to a local mortgage broker. He had been in the business at that time, 30 plus years. So I asked him, what do people do after multifamily? Not that there's this progression, but a lot of folks think there is. So single family, multifamily, but ask them, what's next? What do people do about that? And he said they usually go to medical office or triple net, and not because you make more money, but because you have a lot less headache on the operational side. And so that was like, okay, cool. So I checked it out. Started really liking dollar stores. So our first fund in 2017 was $7 stores, so Dollar General from the Dollar Tree. Really liked that, and it really grew quickly with our investor base. So our fourth fund, we raised $20 million of equity on that fund, and so it's just great to see the ramp up. But folks are really wanting that monthly income, and that's usually for more folks that are kind of older. They want to drive around their RV, and hang on the beach and have that monthly ACH come in. Those are great options. Now they're probably giving up some of the total return because we have long-term our average is about 7 years leases on those. It's a blessing and a curse. And so you've got, you're going to get paid for 7 years at least on that lease, but your rents are fixed, right? So you don't capture the upside on the inflation. Sure. So, but it's a tool for folks that want that monthly cash flow.
And what kind of returns should people expect in that kind of triple net asset class?
So we're 100% high credit tenants. So we don't do strip malls with mom and pop owners. We're all high credit tenants. That's, and almost all of them are publicly traded parent companies that guarantee our leases. Mm-hmm. For our investors, we're hitting about 8 to 9% cash on cash annual, paid monthly. And then on top of that, there are 25-year amortizing loans. So you're hitting about another 6 to 7% of your total return just paying down the loan. It's its equity build up in the property. And then appreciation, we don't have that as many levers to pull like we do in multifamily. So if we assume another 2 to 4%, we've seen it more than that for the past 6 years, but it was good timing probably on our part. So we're right about that 15 to 17% total return in a year mark. With about, half of that being cash flow.
I mean, those seem like solid returns for triple nets. Is that a function of really timing and buying and, starting in 17? And we know there's been a lot of appreciation since. Is that, and I guess, how do you look at that versus what do you expect out of that kind of going forward in the market we're in now?
Sure. Yeah. So I think we'll hit 8% this year in this fund. This year, the prior funds were hitting more like 9 or 10%. And then we've actually we mix in a few blend and extend, which is a whole bunch of jargon, but what that means. So we bought a Walgreens with 2 years left on the lease in December of this last year for the last fund at a 12 cap, which is amazing. Yeah. So we know a lot of those kind of the regional managers that are in charge of saying yes or no if there's going to be an extension or not. Yeah. Sometimes we get a yes, sometimes we get a maybe. If we hear a no, we bounce out of the deal on the LOI. Sure. But while we're under LOI, we give them a call. Hey, are you going to renew the store? This one said yes. We obviously can't get the renewal until we sign the docs, or till we buy it. But they did. They just signed in January a 10-year new lease with us as well. So now that thing's valued at probably a 6.5 cap, which is amazing. So so we're able to do a refi, pull out a whole bunch of cash. So that's another way we try to get that cash on remaining equity up because we'll return some of that cash to the investors as well. So we try to do.
You're able to go in a little bit of a riskier situation with a lease that's maybe almost up. Get in, secure a longer term lease, and then refi, and all of a sudden you've created value.
Exactly. And we only do that on maybe 2 or 3. So last fund, we ended up buying 26 stores. So it kind of, that mitigates a lot of that risk if you can blend in 2 or 3 of those. There's some risk on that, but
that's interesting.
But anyways, yeah.
So as you think about that on kind of this side versus some of the other strategies, so that one really came out of, sounds like, investor appetite for steady cash flow and returns. So you had to meet that need. You talk about on the other side as you looked at, why, if things are going well, you're acquiring, you're doing value add, you got this going, why dip into new development and then into the office conversions?
Sure. And it's really, I just didn't want to be pegged into one thing. I wanted to have, a multi leg stool, if you will.
Yeah.
And like, as we're seeing now, if your sole business is to buy existing multifamily, there's about zero deal flow right now. Not quite zero, but I'm exaggerating a little bit, but it's not much.
I mean, we're feeling the same thing, right? If we weren't working on a couple of new developments as well, things would be pretty quiet. And so absolutely.
Exactly. How many calls a day do you get from starting brokers about wanting to sell your deals? I mean, it's insane. That tells you how slow it is. Like, these guys are just hurting.
It definitely feels a lot different than this time last year, right?
Oh, for sure. Right. Yeah.
I mean, it's definitely completely flipped to the dynamics on, I think, the broker relationships.
Right. Yeah. So really moving to development was we had some younger investors that wanted more growth. Right.
Yep.
And that was a way for us to grow their money faster. There's probably a little bit more risk to it. But as long as you mix it in, you blend it right, it's an appropriate tool for some investors for sure.
Sure.
But there we're looking to double their money on paper in 2 to 3 years,
Yep.
typically on our ground up. Our office conversions can be bigger than that, especially if they're historic. So we have 7 historic properties in our portfolio. You get free grant money from always from the state, the federal government, and then you
Sure.
most of the time get it from the state as well. So that really juices the returns. So
Sure.
those can be higher as well.
Sure. Well, I love how you've put together this multi-leg stool, as you said, with different risk profiles, different return profiles. And it really is something, like you said, from the investors that are in their 20s all the way to investors up in their 60s, 70s, as they're getting older, there's something for everybody, right? And you can create that
Right.
diversified portfolio within your real estate holdings. So that's
Exactly.
really well thought out.
Thanks. Yeah. Yeah. We like it. It works well. We have a great team at the office that helps push all 3 down the road. So
Yeah. And I'm curious on talking about a little bit about that. I mean, you've got a lot of things going on. I'm curious a little bit more about what does the team look like? I mean, how did you scale from, yourself kind of up to where you are now? And how did that team grow as you continue to diversify and do more things?
Sure. So we're at 19 now at in our investment office there in Plano. We also own the management company. So they have 280 employees. That's where most of the on-site employees
Hmm.
sit, is on the management company. So we have way more employees there. But from the investment side, we're at 19 right now. And really was, as we were, as a new syndicator, you're trying to put your third, fourth deal together, and you're going crazy because you're wearing all the hats. You're at
Yep.
least back then I was having to scan documents, and not we didn't have DocuSign and all that.
Yep.
So anyways, I was having to do it all. It's like I can't do this anymore. So I kind of sat down and saw where my weaknesses and things that I didn't feel like I was adding a lot of value on, like scanning documents. So I hired an assistant, but she also had a background in digital marketing. So that was a weakness of mine. It was digital marketing. I'm more nuts and bolts and get the information out. But she wanted, but I need someone who would make it look pretty, right?
Yeah.
So she was the first hire, and then the second hire was an asset manager for our multifamily properties, because we quickly got into different markets and states as
Yeah.
well. Because again, to diversify our deal flow, and to get access to new markets as well. So I couldn't travel everywhere, so I had to hire someone else who could help me out with that, and then it just kind of kept growing the team as needed.
Gotcha. In the development work, is that a separate team or is that something that you
Yeah,
oversee?
they're separate. Yeah, they're separate. So I have a manager for the development, the triple net, and the existing multifamily, and then there's now we have a second layer below them now.
Gotcha. No, I love it. I love just to hear how the growth story comes together, because it always starts with one person wearing too many hats. And then it's how do you
That's right.
the businesses that are successful are the ones that get out of that, right? It's that, but I
Right.
feel like so many groups get stuck at that level where it's either you or you and a partner or something, and you're doing everything. And it's that next step that stops a lot of groups, I think, from being successful.
Right. And what's nice about having those 3 groups separate, but it's nice to have them there, but they also kind of they cross pollinize as well, or cross
Mhm.
pollinate, I should say.
Yeah. Yeah.
They Because like our downtown office buildings, we're going to have triple net stores in the bottom floor, right? So our triple net team can help our development team, and our existing multifamily can remind the development team that our maintenance guys do need a shop, and work on that kind of stuff, right? So it's
Yeah.
everybody. We do have meetings with all 3 to kind of help each other out.
Yeah. I love that. I love to hear how that comes together. So as you guys are looking at the market right now, and maybe some of the strategies like the office conversions play into this, but just starting more broadly, as you're looking at where things are now, right? I mean, right now where we're at, it's March when this post probably April 2023. A lot of uncertainty in the market, right? A
Sure.
lot of uncertainty with banks, with interest rates, and what are we doing? We already talked about how the dynamics of multifamily has really flipped, and there's not a lot on the market. So, I mean, how are you looking at just the multifamily market right now, and what are you looking for in deals? What are you staying away from in deals?
Sure. I mean, I think our existing multifamily acquisitions are going to be very slow the rest of the year for 2023. just because deal flow is. I mean, going out to NMHC in January,
Yeah.
everybody was talking about how slow it was going to be, and so
Yeah.
I think everybody's pretty much right on that. So we look at new deals. We're more gravitating towards B's and A's now in our
Hmm.
portfolio, less on the C stuff. But I think the big growth for us is going to be the triple net side, just because we have a lot of equity coming our way. And then we also have, and there are just better and better deals out there that we're finding too. And then on the development side, um, I see a lot of these office conversions coming over to us. We've kind of
Hmm.
made a name for ourselves on a few key big acquisitions. And like I was on a call yesterday with a hedge fund out of Boston. They reached out to us directly because they have some very low occupied office buildings. And so we've run through one. We had our architect look at it, how many units we can fit in this space,
Yep.
and got them some information. So I think, and they've told us they've got about 10 that are coming our way if this one works out. So that's been good. And then we
That's
were
great.
contacted a few weeks ago from another office lender that foreclosed on an office building in a downtown location, and they
Yep.
reached out directly, and we're gonna probably take that project on as well. Because so this office conversion, this office foreclosures it's about to be real for these guys the next 12 months. It's
Sure.
coming soon.
Well, I think that's a great niche you've identified, and a good opportunity to take advantage of, and something that's a little unique, right? So let's dig in a little more to understand that. I mean, I guess just talk us through what that looks like. Like, what are some of the complexities or things that you've got to think about differently when you think about taking office and turning it into multifamily?
You have to hire a very good mechanical engineer, because
Mhm.
it's all about plumbing, right? You have to add a
Mhm.
lot more plumbing and
Sure.
toilets,
Yep.
and other systems too. The electrical grid typically has to be upgraded as well. And every deal is very different. So we have our oldest building is in Atlanta. It was built in 1898.
Oh,
So
wow.
it's very historic.
Yeah.
It's got its own Wikipedia page. It's pretty cool. And then our youngest office building we're working on right now we've got framing going up. This 1981 build. It is also a historic building. We got that through somehow, some way, but it's a historic building as well, which is a key deal. So those are really cool because you get a 20% grant from the federal government on your hard construction cost.
Hmm.
Which is a big deal, right? I mean, an example is that one of our deals there in downtown Cleveland. We raised $9 million. We're going to get about $16 million between the federal and the state historic grants, which is a huge return, right? We've already doubled the money without even swinging a hammer when we can find those deals like that.
That's
So
fantastic. Wow.
and then the other cool thing about those conversions is that usually we're between 50 and 100 grand cheaper a unit if someone were to build a ground up in that same location. So we've got a better basis. Our walk
Yeah.
scores are 90s and above on these locations too. Anyway, so we
Is
like it. It's
the
also
I was just gonna ask, is the better basis just because it literally costs less to do the conversion, or is it because of all the grant money that comes in?
the grant money takes a piece of that, but also
Yeah.
if when we're working with the existing windows, we've got the
Sure.
exterior.
Yep.
Sometimes we can repurpose the elevators; they're fine. Sometimes we have to get new elevators, so it's a wide range. But and some of it, like I said, some of it's the historical piece, but really it's we've got a roof, we've got windows, we've got walls, and
Sure.
usually some systems we can reuse. So there's some savings there that we get.
Gotcha. Interesting. So how do you take an office building and make it feel like it's somewhere you want to live, right?
Right. Yeah, exactly. If it's a historical asset, we have to keep the hallway the exact way it was when it was built. And so usually what happens is usually you have kind of wide units and kind of narrow to the windows from the entry door to the windows kind of is not narrow, but it's smaller than you typically would see. We have to
Mhm.
go out. If it's not historical, we can move the hallway wherever we want. So we can make it feel just kind of like an A-class high-rise, multifamily building.
Yeah.
And the historical piece is nice because you keep like I'm in one right now, one of ours. You got the marble on the hallways. You got the real tile from the 1920s.
Yeah.
Just
Really cool
all
stuff.
that kind of stuff. Yeah. So folks like these as a kind of a speaking, like a speaking piece of kind of where they live.
Yeah, absolutely. So these aren't really like big downtown, like glass and metal office buildings as much as they're, or is this some of that too? That's what
It's
I'm
some of that
thinking of
too.
is
Yeah, it's some of that. So
how do you make that
yeah,
feel like homey?
exactly. So we have so one of our like the one built in 1981 is a lot of glass. It was the old Ohio Bell headquarters in the 80s.
Oh,
So that's kind of it's 526,000 square feet. So that one is a lot of glass. The cool thing about it is, and a lot of tenants will and residents will overlook the office field because you've got huge windows. I mean, most of the time they're floor to ceiling windows, which
yeah,
is kind of cool.
yeah,
You don't get that in your traditional kind of high rise or multifamily deals, somewhat. And then really it's about, the hallways, the entryways. There's not much you can do to the exterior, right?
sure,
There's really not much, especially on a 17-story building.
sure,
And then if it's historical, they really don't want you to touch the outside of the building. You can't do it
yeah,
to get the grant. But inside, we've got nice amenities. We've got a gym. We've got, movie theaters, dog wash stations, usually an indoor dog park, especially in Cleveland. And other things like that to make it more homey and a really high class amenities.
yeah. Very cool. It's just it's an interesting, definitely an interesting model, but something that like you said, is probably going to become more and more needed. I've heard much more about like the hotel to multifamily conversion than the office to multifamily conversion, but it sounds like this
Sure.
may be the next thing.
We like the hard ones. So
Yeah,
it is definitely harder to do office. It's a lot more toilets and plumbing. You got to run through
sure,
the deck and all that. For
sure.
sure. But it all comes down to me is the locations are just irreplaceable of
Right,
these assets.
right downtown.
Yeah.
Yeah. Well, fantastic. So, I mean, again, just kind of going back to the market, going back to your outlook on things. So it talks about it sounds like the acquisitions be relatively slow, maybe leaning more into triple net and office conversions. Um, and what are like general thoughts on kind of where the business goes from here? What are you most excited about over the next year as you look out to what you guys are going to accomplish?
Sure. I mean, so kind of overall market, we have a huge housing shortage still in this country, and it got worse over the past 6 to 12 months. So, June of last year, there were 3.6 million housing units short across the country.
Mhm.
It got worse because the interest rates went up, and then a lot of single family builders stopped building spec homes.
Right.
So that slowed down that as well. So now it's even worse. I haven't seen the latest numbers from RealPage yet, but we know we have a shortage in this country, and we can't build properties or produce residential units fast enough.
Mhm.
Which me, I'm a long term investor, so that means rents or demand is going to outstrip supply for the foreseeable future. So rents are going to go up. We're going to see more and more people's paycheck go towards rent. I think,
Yeah.
especially in the states that we're in, we're going to catch up to, maybe not fully to New York and California, but it's going to start being higher than 30% of their paycheck going towards residential. It's going to have to. There's no place for them to go. I mean, it's got to be. There's going to be a lot more apartment renters in the future. So I'm very
Mhm.
bullish on the space. Now, how do we participate in that? It's a little crazy right now to get existing multifamily because you've got owners that are convinced that interest rates are going to fall in the next 12 months. So
Right.
no one's, hence why the slow,
Right.
sales market. And I'm one of those too. Like if you were smart and had either had a fixed rate loan or you bought rate caps, there's no reason for you to sell. There's no kind of fire sale going on.
Right.
And even if you did, the rents grew so fast the past 2 years. I mean, double digit rent growth for the most part across our whole portfolio. It chewed up a lot of that interest rate hike that we had to hit until our rate caps kicked in.
Yep.
So we're not paying out as much cash flow, but there's no reason to do a fire sale either. So I don't think we're going to see a big crash this year. I just don't see it. Um,
Yeah, I mean, I've had
you know,
the same experience, right? It seems that the people that are selling right now are selling for some reason. I mean, maybe the rate cap's running out. Um, or they've got an assumable loan that is all of a sudden very attractive, right? Because it's
Right.
locked in at a low interest rate. But yeah, you're not seeing people go to market unless there's some catalyst or some reason that they need to sell.
Right. Exactly. There's just no need because you know, demand's going to outstrip supply all day long for the next 10 years or so at least. So if you're smart, you can hang on to your real estate longer.
Yeah, and that's awesome. And so as you guys going back to the question, I mean, what are you most excited about if you look out over the next year on where you guys are going? I mean,
Sure.
what's your focus?
Yeah, I mean, really, I set the goal of hitting $1 billion of assets under management by 2029. We should
Mhm.
hit that by the end of the year. A lot of that's due to these office conversions. They're probably the smallest one's going to be worth $100 million.
Wow,
So we're going to finish a few of those projects that are pretty big, and that'll push the assets under management. So we're ahead of schedule on our AUM.
quite a bit.
Yeah, so we beat that pretty quickly. So really, I think it's these. I think it's this. It's ground up development. We're excited about that. We're still finding some good land deals down here in Dallas, Fort Worth, and then even in around Cleveland as well. Cleveland, I don't know if you know this, but Cleveland gets a 15-year property tax abatement, kind of with no strings attached, which is a huge deal in Ohio because
Wow,
our
yeah,
property taxes
that
are
is a huge
crazy
deal
high.
in Ohio. Absolutely.
Yeah, so that goes away in 20, like if you don't have your plans approved and submitted by the end of the year, strings get attached. So that's going to be interesting to see what happens to Cleveland ground up. It's going to really probably uh, be put on pause
Yeah,
because then you got to do rent caps to get the abatement and all that kind of stuff. So
just like
um,
almost everywhere else.
exactly. So right now we're pushing hard to get as much of our ground up Cleveland stuff through and approved,
Yeah,
and then we'll probably back off there. But that'll be a big focus. The office foreclosures are coming because if you signed usually when you take office space you sign a 5-year lease, and so right now we're still that if someone signed a brand new lease before COVID, it was still before COVID, and so now they're probably going to need less space, not zero space, but probably less space. So you're
yeah.
going to see this whole kind of readjustment for the whole office building. So if you got folks that are 30% occupied now, they're going to be really hurting. So I think that's going to be a big business for us the next 9 months or so.
And you think that's largely going to be driven off of lease term
Yeah,
as
for
leases
sure.
come around?
Yeah, leases are coming up. Their mortgages are still there. The
Mhm.
mortgage market for office space to refi is about non-existent, and that's again an over exaggeration. But
Yeah.
so it's. I mean, I've heard maybe 40%, maybe 50% leverage, and so these guys aren't going to be able to refi their way out of it,
Right.
out of the mess they're in. So we've done a few JV deals where the owners came to us. We actually partnered up with them so they don't lose their shirt. It's a
Yep.
win-win. We structure it as a win-win. So we've done 2 of those now. We're working on a third, and the other 7 we bought out, or 8 we bought out ourselves. So
Man, really interesting. I love learning about that space. So it sounds like something for people that are listening really to hone in on. Sounds like there could be some good opportunities out there, and whether folks are active or passive, there's going to be good investments. It seems
for
in the
sure,
office to multifamily conversion space. I think it's a great nugget.
right? Oh, thanks, man. Yeah.
Yeah. Well, Kenny, it's been awesome having you on. Want to wrap things up as we get to time here, but I want to take you through our keys to success round. So I've got 4
Okay.
questions that I ask everybody. No brain teasers, but just the first thing that pops into your mind. First one, you got to put your investor hat on, right? So if you're an investor, you're investing in one of your investments and you could only ask one question to the sponsor, what would that one question be?
What's your experience in that asset class?
Yeah.
Because you've got I mean you can have a killer deal on the land acquisition or the basis in the existing multifamily, but if you can't run it right and don't have experience doing that, then you can really screw up a great deal quickly.
Yeah, I mean, the operations is everything, right? And I think the more deals we do, I mean, the more I understand that as well. It's like having a great manager, having a great asset management team, like that makes or breaks it at the end of the day.
Right, for sure.
Yeah. What are you most proud of in your career?
Um, I've got a proud dad moment now two now, I guess, but I've got a daughter. She's 14 now, but she bought her first single family rental at 10. I started taking her on business trips when she was 5.
Yeah.
She bought her first rental at 10, sold it at 12, made 50 grand. And I told her that's not typical. And then I told her, now you have a tax problem. And so
Yeah.
so I walked her through how to use cost segregation and bonus depreciation to offset all that. So she didn't pay taxes on it. And so she's really kind of dialed in now. She's getting more and more dialed into the family business on that. And then my son's 5. I got back from his first business trip. So when they're 5, they start going with me on a business trip. So he had his little hard hat walking around our downtown Atlanta office conversion project. So he did good. He got to drive the buck hoist. So
That's awesome. I love that. I love that. I've got 3 small ones myself. They're 7, 5, and 3. And I love that you're getting them exposed early and
yeah,
getting them into the business. It's
that's
fantastic.
great.
That is awesome. What is a book that everybody should read?
Um, so besides my 2 books, no,
Ooh,
so I do have 2 books out on
you got 2
Amazon,
now.
but
Okay.
2 now. We got one. I pushed one out. Maybe it was in January. We got that one out. So,
Fantastic.
um, yeah, I don't know. I mean, I always hate to use the cliche, but I mean, to me, one that really kind of changed my life was one of the first financial books that changed my life was Rich Dad Poor Dad. I'm
Sure.
sure that said a lot here,
Sure.
but for me, it was a big deal. My dad did well. He worked for an oil and gas company for 40 years, and did well. Stocked everything away. It was all stocks. So it's all that I was taught, and I just
Yep.
didn't feel that was like the right way for me going forward. So really, reading that book freshman year at Baylor
Yep.
was a big kind of life changing moment. Was, oh, there's a different way to do it. So, anyways, that really, and I was always an entrepreneur at heart, even when I was little, and so that really spoke to me and really moved mountains for me personally.
No, I love it. And it is said a lot, but it's said a lot because it's impacted a ton of people and it's
Right,
important. And I think it's just such an easy, approachable way to kind of start to change your mindset, right? From all that we're taught throughout. I mean, I was very much the same way. It was all stocks, um, a diversified portfolio with stocks and bonds, right? And different
right,
types of stocks. So like they leave
right,
out so much more that's out there, different asset classes, right? And I
right.
think we're both of the belief that real estate belongs in everybody's portfolio. I mean, there's a spot
Absolutely,
for everybody. So if you really want to be diversified,
right.
awesome. Last question. What is your number one key to success?
Oh man, I love what I do. I mean, that's probably said a lot too, but I mean, I really do. I don't think that this is work. I love going into the office every day. We've got a lot of really cool projects going on, not just on the development side or office side, but
Mhm.
really our triple net side's great too. I love seeing those just monthly checks roll in to go out to our investors.
Yeah,
And really, is that the key is just doing what you love. I mean, I think that's a huge piece to people's lives. You spend more time there than you do with your family, so you better love
that's right.
it.
That's right. Well, yeah, you've got to turn your passion into work, as they say, right? And
Right,
so
exactly.
I think,
And just
yeah,
hope it pays well.
and just hope it pays well. Right, right. Yeah, right, yeah. Can't just be a hobby. But
Right.
well, that's great, Kenny. Thank you so much for coming on the show. I love the lessons around, expanding outside, starting, getting really good at acquiring multifamily, and then using that expertise to expand even further into different avenues. And now you're doing some really cool stuff with triple net, stuff with office, building new ground ups. You've really been able to expand that business and grow. And congrats on likely
Thanks.
hitting a billion this year, like 6 years ahead of schedule. So I think
Yeah.
that's great
Yeah.
lessons for
Thanks.
folks to learn.
Thank you very much. I appreciate you having me on, Kent.
For sure. And so if folks want to get a hold of you, how can they reach you?
Sure. The best way is our website. So Wolf with an E dash investments.com. We've got a YouTube channel. We put out educational videos every week on there. We just released another property tour video where we showed it before and after. A lot of folks kind of like that stuff, kind of
Yeah.
the HGTV type type seven
Yeah.
minute show.
Yeah. Great.
So we do those, and then I speak at a lot of events around the country as well. So I'd love to hear from you guys.
Awesome. Well, yeah, we'll make sure that's listed below and we'll make sure that everybody can reach out to you. And Kenny, I hope you have a great rest of the day. Thanks again for coming on.
Yeah, thanks, Kent. Appreciate it.
All right. Have a good one, man.
You too. Bye.